think it's probably likely that we're going to get a cut in September. I do not think we're going to get a 50 basis point cut, just to be clear right up front about that. I think it's important to keep in mind, the market is super excited for rate cuts to come. It has been for a long time. Coming into 2023, the market was expecting the Fed was going to be pivoting at any moment. Jerome Powell had to continually tell the market, nope, I'm going to stay higher for longer. The market kept saying, I don't believe you. But who had to blink in that game of chicken? It was the market. It was the market all the way along. Even coming into 2024, you probably remember there was a time when the market was expecting somewhere upwards of like 6 rate cuts from the Federal Reserve. Still hasn't happened yet. So I think Jerome Powell is serious that he's going to, take the time he needs to feel confident that inflation is coming down on the trajectory that he needs it to come down on. Now, that being said, I think the Fed is going to take heart from this latest inflation report. CPI, headline CPI, now has a 2 handle on it, right? I think that can make the Fed feel like, okay, I'm showing the world I'm getting the job done here. I think it is taking longer than the Fed would like, obviously. So one last thing to think about here too is the GDP growth for Q2. The initial report came in at 2.8%. Yes, the unemployment rate is rising now, but even still at 4.3%. That's historically a low and considered very healthy unemployment rate. The market is near its all-time highs. The real estate market is at all-time highs nationally on average. So these are generally not conditions in where the Fed is doing aggressive easing, rate cuts. If anything, these are conditions where the Fed is sometimes asking the questions, hey, is the economy maybe performing too well and we still need to cool things off? So, I do think for those that are expecting, 50 basis points or even more, I know an economist that called for an emergency 75 basis point cut and then another 75 later in the year. I think they just need to slow their roll. I do not think that's going to happen. I think there are pockets of the economy that are probably likely in recession. And if you talk to the average consumer out there, 3 out of 5 consumers say that their household income is not keeping up with the pace of inflation. So I think that there's a good chunk of the populace that would say, hey, I don't care what the headline numbers say or the official numbers say, I feel like I'm in a recession here at this point in time. To the spirit of your question, though, I think it is going to get worse going forward. I can't say with confidence when a recession will be called. Now, obviously, we just had the Psalm rule that was triggered a little over a week ago. So technically, by that indicator, the economy is in recession already. But if you look at everything from, consumer spending to consumer levels of indebtedness to if you just scratch below the, otherwise rosy headlines in the jobs market, you find a lot of really heavily concerning data where, hires have dropped back down to pre-COVID levels, quits are down, which shows that people are worried about being able to find a job if they leave their current job. If you look at the fact that pretty much all job growth creation that has happened has been in part-time jobs and not full-time jobs, if you see that hours worked are slowing down, these are all pre-recessionary signs, right? So I think that, even that 2.8% Q2 GDP growth that I mentioned earlier, that rate, that's an initial reading. And those initial readings tend to get revised downwards. And in a lot of the data that I just mentioned there, whether it's GDP data, whether it's employment data or whatever, the strong trend over the past year, when the current number gets published, all the previous numbers get revised downwards. And that process doesn't seem to be moderating at all. In fact, it's probably getting worse. So sort of my long-winded answer here is saying, I think we're seeing an increasing number of signs that the lag effect from the Fed's historically aggressive rate hiking campaign are finally beginning to show up. I think Wall Street had really begun to hope that it somehow had dodged a bullet and somehow this time was going to be different and the Fed was going to have engineered this immaculate disinflation, this soft to no landing scenario. I think the hard landing is probably likely still the probable outcome here. It's just taken its time to arrive, but I think we're finally at the point in the timeline where it is increasingly beginning to arrive. Well, we got a lot of things coming up this year, and obviously a really big one is the election. If you're up for it, I'll share my little armchair opinion on what could happen post the election. I think regardless of who wins, the incumbent at the time, or the person coming in at the time, is going to have a personal interest in letting a lot of the current froth that's in today's markets and a lot of the extraordinary engineering that's been underway to make the economy, look as good as it can heading into the elections. I think whoever wins in November has a personal incentive to let that stuff end and let some sort of expression of natural forces remove the froth. And the reason why I say this, I don't think it's a surprise to anybody, or would be a surprise to anybody, that the Biden, now Harris administration has been using a lot of unnatural acts to try to keep things as belted together as it can to get to the election day. And they know they can't do that forever. They know that there's a cost to that. So if they get reelected, Kamala Harris wins, she'll say, look, you know what, let's let some of this stuff correct because we're going to have to. Let's have it do that early in my tenure. So yeah, maybe I'll have a rocky first year or so, but then things will bottom out and then I can really finish strong and I can look great in 4 years, right? Similarly, if Trump were to win, first off, the Harris campaign would stop doing what they're doing anyways because, hey, we don't want to help that guy at all. And secondly, he would say, great, let it all correct. I can blame it on the previous administration for my first 2 years. And again, I can end strong and look like a hero at the end of my years 3 and 4. I feel like, look, there's lots of reasons on the macro side to expect things to slow down, to expect market returns to get more challenging going forward. But I think we have this event with the election where the people who have been trying to hold the system together and make things look as rosy as possible to date actually have an incentive to stop doing that for at least some period of time. I think the biggest opportunities right now is, look, there's not a lot of things that are undervalued. So I think the general risk to asset prices, especially if the status quo starts changing, is to the downside. So I think the opportunity here is to basically preserve capital so that if indeed there is the type of correction that you and I are talking about, you're sitting in the catbird seat with dry powder to deploy at better valuations. And who knows how long they're going to last, but being able to park, if you expect that inflation is going to come down over time, interest rates are a function of inflation expectations, there's potentially emerging opportunity on the longer duration side of U.S. Treasuries as well. And that might not be a bad place to put some of your portfolio right now. I'm sure we'll talk about the precious metals, but that is one asset class that actually seems like it's got a lot of good tailwinds behind it for a reason right now. And that could potentially buck the trend of what we're talking about, although even precious metals themselves, if there's a general market sell-off, will probably get sold off at least at the beginning of that for margin call reasons. Yeah, surprised me, maybe just that, gold has finally started to make the progress that I think folks like you, gold watchers like you and I, have been expecting it to make over time. I think like many people, I invest in gold, not because I like shiny metal, but because I have a concern that the purchasing power of our currency, and this applies to all fiat currencies, not just the US dollar, but I feel like that is the safest bet that I can make, is that over time, the purchasing power of the US dollar and other major world fiat currencies is going to continue to decline if our policymakers continue to pursue the policies that they have been pursuing. I don't see any changes to the policy strategy going forward. So again, that's why I think this is one of the safest bets to make. And it's a big reason why I invest in gold. I mean, it's not just me, it's like you, I interview a lot of experts for my day job. And even just recently having interviewed Thomas Honig, who was a former head of the Kansas City Fed, and then was a voting member of the FOMC under the Bernanke era. That's his opinion as well, right? It's the surest bet that he knows how to make. So if there's anything I'm surprised about, it's pleasantly, is how well gold has performed this year, and I think will continue to perform from here. And Grant is famous for having written a report getting close to 8-9 years ago about gold, which was that nobody cares. And, us long-suffering precious metals investors, remember back in those days where we were buying gold for all the reasons that I think most investors are buying it today, but not seeing the response in gold, even despite QE and all the money printing that was going on post GFC. I got a chance to interview Grant yesterday, and I asked him, all right, Grant, so where are we? Does anybody care about gold? Is the world starting to care? And he said, not everybody, but increasingly important cohorts are. So central banks are definitely caring about gold. They've been buying at record levels for much of the past couple of years. That trend seems to show any signs of slowing down going forward. The Eastern investor has cared a lot about gold. And when we look at the shift of gold ounces from west to east, they're basically willing to buy as many as we're willing to send over that way. It's been the Western investor who really has been asleep at the switch. And while Grant says they still largely are, the Western investor may be actually finally cracking open an eyelid to see what's going on here. And why I think that's so exciting, and this is where I get, pretty sanguine about gold's prospects from here, is Wall Street really doesn't like gold very much generally, but what Wall Street loves is momentum. And gold is starting to show momentum. And Wall Street will jump on that bandwagon at some point. And right now, I think the average portfolio allocation in the West to gold is something like 0.5%. And historically, that's been more somewhere between like 2 and 4%. So, gold allocation could easily quadruple from here and just get back to historical averages. So if the momentum behind gold causes Wall Street to wake up, Wall Street jumps on that bandwagon, and Western capital really starts flowing into the gold market, that's going to have an explosive effect upwards on the price of gold. And I think things could get really exciting from there.